For the confirmation, I welcome you all for the webinar on algorithmic trading and recent market event. My name is Akhil Tenwala and I am Senior Program Manager at QuantInsti, which is the pioneer institute in algorithmic trading training. I would like to introduce you to all our faculty and today's webinar speaker, Mr. Nitesh Khandelwal, who is a co-founder at iRich Capital Advisory Private Limited, as well as QuantInsti. An IIT and IIM alumnus, he has a domain expertise of about a decade in Indian as well as global market. I would now request Mr. Nitesh Khandelwal to take over from here.
Right. Hello, everyone. This is Nitesh Khandelwal this side, and I welcome you all to this webinar on algorithmic trading and recent market events. It's good to see a very good turnout on a Tuesday evening. So thank you first of all, thank you all for being present in this event, and I'll rush you through the agenda for today. The agenda would be looking at the recent market events, and we would try to cover different market events, including black swan, gray swan, as well as white swan events, and how they impact the markets, and especially the HFT firms in general. We would also try to cover a bit on the EPAT, the Executive Program in Algorithmic Trading, QuantInsti's flagship program on algorithmic trading, one of the first of its own kind across Asia Pacific, and see how it helps in the HFT trading strategies, as well as how it relates with these market events as well. So welcome again, and let's start. So let's start with the event definition. What exactly do we mean by a market event? So market event, it's not a textbook definition, but it would be anything significant that can impact the market in terms of price movement or market microstructure. So price movement is one thing that, okay, if something has come, if some event has happened and it is impacting the price of the stocks or the index or the forex, whichever way it is, so that is quite visible directly. But there are certain events in which you would see the impact is a deep impact on the markets, but not in terms of price movement, but how the market starts to function after that. So we have tried to categorize it into three parts. One is planned event with known outcome. Another is planned event with unknown outcome. And then there are unplanned events, so which are like surprises which you see in the markets. So surprise news, surprise decision by the governments, or surprise coup, or anything, right? So a lot of things which are happening globally these days. So those would fall into the unplanned events which are not really planned. So let's try to categorize them a bit more on what are the various characteristics for these various type of events. So for a planned event with known outcome, it would be categorized by a volatility which is post-event volatility, which is really not very high. Profit potential for the opportunity-seeking firms, that would be relatively low. And the disruption in the market is generally limited, right? So planned event with known outcome would be something which has been decided long back, but comes into the play, say on a certain date, right? So you would not see a drastic move in the prices or the volatility at that time, but it might have an impact in the way market behaves, right? Then we have planned events with unknown outcome, which is something like a referendum, which we recently saw for Brexit, or other election results, or policy events. So there you would see price volatility on the day of event to be high to extremely high. The profit potential is generally extremely high. Disruption is limited because of the primary reason being that people have had ample time to prepare for that event because it was a planned event again. But it had an unknown outcome, so volatility is there, but the market disruption is generally limited. Right? Profit potential extremely high, primarily because you have time to plan for it. So if I know that on next Monday, on coming Monday, there is some big event which is coming in, so I'll make sure that everyone in my office comes on time, everyone is, all the servers are fully functional, the backups are ready, everything is there, right? But in case of an unplanned event, we don't know when it happens, right? So it can happen anytime at a sudden move, right? So in those cases, the volatility, since it's a totally unexpected event, the volatility is generally always extremely high. The profit potential is high for the firms which are ready, which are prepared, but it would not be extremely high. I would not categorize it as extremely high, primarily because there is a limited time to prepare for it, or there is no time to prepare for it at most of the times. So given that, with the profit, given that the volatility is going to be there, so the profit potential is there for most of the traders, most of the non-directional traders, I must say, and then the disruption is really high. So these events take the market by stroke, and it can lead to very, very disastrous in either direction, in a disastrous manner. So a lot of firms, a lot of people can get affected by that. There can be repercussions, primarily a lot of repercussions. So these are the three different categories of events, how we have categorized them. This is obviously not a standard categorization, but something which helps us understand how the various events are and how do they relate to the aftermath that follows to that event. So let's see. So we have taken three examples here. So there is a black swan here on the top, which is characterizing your SNB event. So Swiss National Bank, when they removed the peg with euro in January 2015. Then we have a gray swan event. So the SNB event, that would be something which is which would be you can say something which is an unplanned event, right? So unplanned event with unknown outcome. Then, unplanned event totally, yeah. And then Brexit, which is a planned event with unknown outcome, which is on your left, that you can see on your left side of the screen. And then we have tried to take another one, which is not the market news as such, but say a transaction. So this one is securities transaction tax, which was hiked in India by the Indian government a few months back, but it came into play on June 1st, 2016. So which means that it was a planned event with the known outcome, but it can also impact the market, and we would see how that happens. So let's look at the first at the SNB, the unplanned event. How does it? What happens exactly on that? So SNB removes peg with euro. So it was pegged at 1.2. So for 1 euro, you were getting 1.2 Swiss franc CHF, right? So this is a graph, a snippet of graph from for USD Swiss franc, so USD/CHF. Now here you can see that this is January, I think January 20, January 15, I believe. Then there's a daily chart, snippet from a daily chart. So in one day, it moved from 1.02, where it was hovering around for a few days, from 1.02 to it came down to 0.84. Right, so almost a 17% drop, in currency, which is huge, right? Now, what happened when this happened? So if you go back a bit, we were looking at unplanned events, volatility extremely high, check. Profit potential high, we'll see. Disruption high. Now let's check on the third point, disruption. How did the disruption happen? What exactly happened at that time? What happened was that you saw some of the big brokers, FX brokers, going down. FXCM had to be rescued by Jeffries at that time. They were like almost on the verge of bankruptcy because of the losses that they saw. Then there were other firms like Alpari, which also came down to the almost on the brink of bankruptcy. Just because it was an unplanned event, there was massive volatility, no one was prepared for it. You give 50 times, 100 times leverage because typically it doesn't move more than 0.5% in a day. So which is what happened, but it did move by 0.5%, but moved by 17% in a day. So which resulted into a lot of defaults, which resulted into a lot of losses to the broker, which results into the closure of business for a lot of firms, right? So that is what we mean by disruption. So disruption is typically really high for these kind of events. Then we have the Brexit, which happened in more recent times. On 23rd June, you had the referendum for Britain exit from the Eurozone. What happened after that? So it was a planned event with unknown outcome. No one knew. Most of the people were not expecting that they would exit, but as the fate would have it, they did, right? So the results came in as soon as they started coming out, late night or early morning on 24th of June. You saw $2 trillion being wiped out from the global equity markets or global markets overall. The pound crashed almost 10% from about 1.44, 1.45 where it was trading around that time to 1.32 where it came down to, and it's still lingering around those levels now. And the third thing, which was interesting and obviously expected also, was that the margin requirements shot up like crazy. So not just for the currencies, but even for the equity markets, because a lot of markets tanked. FTSE itself was down almost 7, 8, 9% at the opening. So the exchanges as well as the brokers, they hiked the margin requirements, and this was in addition to the increased margins that they had required around a planned event. So they were prepared for it, but given that the outcome came in more of a surprise, even more surprise than they were expecting, so that they eventually doubled or rather tripled in certain cases the margin requirements which were there to trade into various asset classes. Okay, so that was for Brexit, a planned event with a known outcome. Then this is what happened for a planned event with a known outcome. So what was there was that security transaction tax months back after the budget, Indian government has proposed that STT would be increased from 0.017% to 0.05% for the options. Okay, so the options, so those who are not familiar with the Indian markets, in India you have securities transaction tax, which is paid, and this was only applicable for the options where you pay on the premium turnover. So the option premium turnover that is there, you pay about 0.017% on the sell side of the leg of the trade to the government. So, and that was being increased to 0.05% from June 2016, 1st June 2016. So which is not really a small jump. It is a reasonable jump. From the retail perspective, you can say that it does not make a lot of difference, but from the high volume traders, those who are trading day in, day out, they got the heat. And the result of getting that heat was, this is a graph which I created for based on the data from NSE India website. So this is a graph just for the Nifty options, the volume of Nifty options based on the notional turnover, which is the data that we get. So notional turnover, and this is in crores, so which is 10 billion rupees. So blue one is the volume, the daily volume for the month of May. For the first, I have taken first 5 trading days of both the months. This is 1 lakh crore, 100,000 crores. This is about 170,000 crores. This is about your 120,000 crore, 130,000 crore, and 130,000 crores. So on an average, you can say approximately about 130,000 crores was the daily turnover for the Nifty options, Nifty, which is the benchmark index, like one of the benchmark index in India. Then this is the blue bars that you're seeing. That is for the June 2016, which happened after the STT was increased. So you can see that these numbers, this is 80,000 crore, 80,000 crore, then 75,000 crores, then about 55,000 crores, and then 120,000 crores or so. So now this 120,000 crore, this was more of an exception because this was also the day of the policy announcement by Reserve Bank of India. So where a lot of volume happened and a lot of volatility was there. So this is more of an exception to the previous 4 days. So the volume fell dramatically, right? So this is, but this, please keep in mind that this is only for the Nifty options volume. This is not the open interest, but only the volume. And we have not included the the volume for the other options which are traded, but Nifty typically contributes to most of the chunk of the overall options volumes in India. Now, and another reason why I have not included all the other indexes and other stock options is that there was this new product which was launched, Bank Nifty Weekly Options, which was launched in on June 1st itself, or rather probably a week before that. So given that there is some contribution from there, so it becomes the comparison does not remain apple to apple, but becomes apple to oranges. So I thought it would be just a good idea to look at the impact, and probably we can get a better idea by looking at the just the Nifty options volumes which we saw. Now, so what does this mean? So let's see what was the impact on the HFT for these. The left one, this is the Brexit. So this is a snippet from Wall Street Journal where you have Virtu shares rise as trading volume source on Brexit fear. So Virtu is one of the leading algorithmic trading HFT trading firms globally. Why it often comes up into the media is the fact that it is a listed company. This was the first billion-dollar HFT company, as in with a billion-dollar valuation, to list on the exchanges, so which happened last year. So you get to read about it more often in the press because the more information is available. So the whole market was down, all the shares everywhere was down, but the Virtu was up primarily, and it was up by almost 2% in the early hours of trading on Friday. So primarily the thing is that for these kind of events, this is when the HFT firms make a lot of money by being in the market, by just being in the market, which is also helpful to a lot of other participants because otherwise the liquidity just dries up. So we'll look at that in more details in the next slide. But yeah, so this is typically a good day when there is a huge volatility in the market, and that's why you see that Virtu shares rising as a trading volume source on Brexit fears. Now, second one on the right is related to the S&P event, which is market making pays off for HFTs amid currency turmoil. So you can see that brokers were going down. The people were getting burned like anything, but the HFT was able to make money around those times just because there was volatility in the market. Right, so it was an unplanned event. Those who are holding positions, they can probably get either really can probably get a big fortune by those movements, or they would go on the brink of bankruptcy. But in HFT, typically you do not really carry a huge delta position. So you carry very small positions. So any volatility, you are well placed to make use of that. So you can make use of of the volatility which is happening in the market and the turmoil that follows. Now, so here HFT makes money. Here HFT makes money. Now the third one, STT hike on options on to pinch high volume traders. This one is related to our planned event with known outcome, which is STT hike. for options trading in India. So this, we do not have the data from the markets, as in from the media, that what happened exactly to the HFT firms, because that data is not public. But from what I can say is, from what I understand, is that the profit opportunities dipped quite a lot, primarily because this constitutes like 0.017% to 0.05%. This is a very steep hike, which and the market takes time to adjust to the new realm. So now you can say that it has more or less adjusted, but at that time, at that point of time, in the following week, when it was it came into place, it did pinch a lot to the high volume traders, which includes HFT traders. But it wasn't the steady hike in itself, but the fall in volume it led to that hurt HFT and other market participants temporarily. So by other market participants, I mean everyone. So whether it be the exchanges or the retail trader or the individual professional traders, it hurts everyone when the liquidity dries out from the market, right? So the impact cost increases for everyone. The revenues for the market, for the market participants, the exchanges or institutions, that goes down, right? So everyone gets a hit when the liquidity is soaked out from the market. All right. So Brexit impact. So what exactly? So let's look at in more details what exactly followed after the Brexit. So FX volumes multiplied on June 23, 24. So on the day, so like June 23 late night US time to June 24 day, it almost, so like there was data from for Thomson Reuters in which on their platform it was almost 2.5 to 3 times the average FX trading spot FX. The volumes are almost 2.5 to 3 times for that day as compared to the average daily volume. All right, so which is huge. Of course, there was huge volume on the day of Brexit, and it was not limited to a single day. The significant activity was there over the whole month. So the same data, which was 2.5 to 3 times for one day, for the whole month also, if you see, it was more than like 20-25% up over the previous month. So overall, FX volumes globally, it I think crossed on that day $5 trillion in volume, which was quite above what we have been seeing recently. So like after 2014, we have never seen that much volume happening in the markets, almost like around maybe early 2015. That was there. And since it was a planned event, liquidity didn't dry up totally, so people were prepared. So maybe the spreads might have widened a bit, but it didn't dry up totally. Unlike the S&P event, when the liquidity went for a toss. So there was hardly any liquidity, and at those times, especially the time when immediately after the event. So that wasn't the case this time, primarily again because it was a planned event. And the participation was there from the banks as well as non-bank players. So liquidity providers, who are there, both from the banks as well as non-banks, they were there. And one of the key reasons why you see now a lot of non-banks also providing liquidity, and various exchanges as well as banks who are now happy to take their liquidity, is primarily because of the more prevalence of the prime brokers and the clearing partnerships that have been formed now, which ensures that the bank or the counterparty or the exchange is not really facing that liquidity provider, but probably his clearing member, a bank. So, which was not the case, as in obviously after the SNB, the prime broking, the prime banking and prime broking industry has gone for a toss a bit, but HFTs were very limited. HFTs had access to that anyways early on, apart from the big few. So now that has increased a bit. So especially the mid-sized HFT firms, they do have the access to the prime brokers, and it has increased probably on that side. So yeah, so that ensures that there is participation from the non-bank players as well. And given the presence of liquidity, it was a smooth transition, more smoother transition than what we saw in the SNB event. So that's why probably you didn't really hear any broker or any bank going down after the Brexit, even though pound went down by more than 10% in a single day, or within few minutes probably. So, so that's again a benefit of a planned event where you can make money with a known outcome, but given that you don't have the you have the luxury of planning for it, you have the luxury for preparing for it. So that's why you didn't see exchanges facing issues, brokers facing issues. So that was not there. So it got handled pretty well, so pretty smoothly. Okay. All right. So what really helps HFT firms make money during those events? So there are two primary factors which helps HFT make money, as in, apart from what they can control, like their own technology, their infrastructure. All those things are something which they can control a bit. But volumes and volatility, that is something which is not in their control. But these are the key external factors which contributes to the success of any HFT, for most of the HFT trading strategies and HFT firms. So which is high volumes and high volatility. If you have high volumes, that ensures that their opportunities you can execute in size, and high volatility, it ensures that the opportunities are there. There can be some disruptions. There can be some something going wrong, right? So somewhere, so which you can benefit out of by bringing back the market to the normal, the new normal, which would help you in the end. In the meantime, you make money while making it efficient. So it's a charity while making money. So that's nothing like that. So so let's look at some of the strategies in which performs in these kind of volatile times, especially during around the events. So one is your typical market making. So market making is primarily when you are making markets on both the sides. That is your standing on the bid side to buy, on the sell side, on the ask side to sell, right? So the idea is to capture the bid-ask spread, especially in the low volatility times. So if the volatility is not very high, at that time you are standing on both the sides, so the price is not moving at all. So people are buying from you at the ask price of yours and selling to you at the bid price of yours. So in between you are making a bid-ask spread. So that is your income from the trading. In the high volatility times, what happens is that you have multiple. So if you are doing the bid-ask spread by pure single destination inventory management, then that can be an issue. What most of the players do is that they have access to multiple destinations, multiple exchanges, or alternatively multiple asset classes or instruments. So what I mean by that is that you're trading in the GBP USD. So but it's not necessary that you are trading only on one destination. You might be trading on, say, 5 different destinations, and you might not be doing a liquidity arbitrage, but you may be buying at one of the exchanges by deciding which one is leading and which one is lagging. So you would be you will be buying on the lagging exchange in case the price is going up in the other exchanges. So what you will be doing is that you are buying in anticipation that it will be going up. So you're not doing an arbitrage, you are doing a market making, but you have a better fair price on that particular trading destination as compared to what others have, right? So that is what we mean by multi-exchange, multi-asset, or multi-instrument. So by multi-instrument, it would be, say, you're trading into options, and there are futures which are traded for that options to futures or cash, whichever way. And if you can get an idea by using your statistical tools or by using your model that which one is leading at what time, so then you can use that input for your market making into the lagging instrument. So in case if the options are lagging, then you can look at the moves which are happening in the futures and try to replicate that in the options. So that way, even though you may not be doing arbitrage, you are still more likely to make money. Okay. Now, Another thing why it is most of the HFT firms go for market making without really covering, sending cover orders on the other exchanges or other trading destinations or other instruments is that the transaction cost is too high. So HFT firms are always wary of the transaction costs which are there, and so to give you an idea about say if a HFT firm is making $200 million in the trading revenues, they would be paying somewhere around probably $60 to $70 million in the transaction cost. So which is a huge amount of money. So of the overall money that they are making, the transaction cost accounts for a huge chunk of it. So given that, you try to avoid paying the trading or both the legs, and rather you try to come up with models, with statistical models where you can trade on only one leg and make profit out of that. Okay. So that's why that's what we mean by multi-exchange or asset or multi-instrument and lead lag that is embedded in most of the HFT market making strategies. Then you have obviously age-old arbitrage, which is there. So volatility in this case ensures or results in disparity at different destinations, and you try to take benefit out of that. This is typically, the classical arbitrage is typically just a speed game. So whoever is the fastest wins. So if you are not fast enough, or even leave the fast enough thing, but if you're not the fastest or among the fastest, then there is no point of chasing a classical arbitrage strategy, because what happens is that unless you are making some additional enhancements to it, which would take it away from being a classical arbitrage strategy. Classical arbitrage is that you're not taking any market risk at all, and you are executing both two legs or multiple legs at once. So which is generally only good for the cases where you are really fast. And the fastness, the cost, there is a cost to that. So you will have to spend a lot on the infrastructure and lines and everything, technology. So which unless you are really getting a good, you are able to get a good cut out of that, as in good profits, then it just doesn't make sense. Then, but the additional volumes, so if the volumes are there, it also means that the opportunities to scale up the revenues would be there in those strategies. Because as I said, that there is a lot of infrastructure that you will be spending it into, especially the cross-exchange infrastructures that people have, especially in geographies like US, where you have so many different exchanges. So it makes sense that if the volume are there, then you would be able to go above the cost that you will be spending on the infrastructure and technology. Then you have machine learning based or directional trading strategies. In this, obviously in the slow-moving markets, they are fine, just like any other quantitative trading strategy or any other directional strategy. But in the fast-moving markets, especially around the events, what happens is that you have so many, so you do not really take a position and hold it. So over here, if we were looking at, say over here, this is obviously one-day chart. Sorry, so I do not have the expanded version of it over here now, right now. But this does not move in a single shot here. Even if it does move in a single shot, from say almost a 10% move, if you drill it down on tick by tick basis, it would consist of probably millions of ticks, if not then hundreds of thousands of ticks at least. This kind of movement. So which means that you will be getting good enough opportunities to go in and come out a good number of times. So probably HFT firm within a movement, say this kind of movement which is happening, say in a minute's time, they would be probably making about at least 1,000 trades, if not more. So given that, what happens is that so in this case, you do not really hold or take the market risk for a very long time, but probably for a few milliseconds at the max in this kind of event, and you you take the position, you get out, then you enter the position again, then you get out again, right? So you are paying transaction cost multiple times, but yes, you are not facing much market risk in those cases. So yes, and not just that, you can even try to make it more sure by if you're incorporating machine learning. Say, take a very simple example of your model has suggested that if there are two or three ticks, on a one side move. So say it was last three ticks are all three buy, buy, buy. Then the fourth tick would be buy. Your model suggests that 80% probability is that it would be a buy only, the fourth tick. So based on that, you can just try to capture that one tick movement where you are much more sure of getting it right as compared to waiting for next 10 ticks or next 1,000 ticks or say next 0.5% or 5%. So that ensures that you have the more winners in your trade, and since you're doing thousands of such trades within a small span of time, you end up accumulating a reasonable amount of money by making sure tick by tick profits. Then you have strategies which include machine readable news and sentiment analysis based strategies. So these are generally more applicable for the events which are sudden again, and the data is coming in, and people are looking at the data and they are reacting to it. But you have on your side systems which can read that data or those news articles by themselves without any manual intervention, which means that they can probably do it in 1/1000th or 1/1,000,000th of the time that a manual trader will be doing. So which ensures that you will have an early reaction to it. So you would be reacting to that news much faster as compared to what other people will be doing. So that also ensures, and sentiment analysis not just includes the machine readable news as such, but even the sentiments that are coming up from social media. So there are a lot of firms that use Twitter feeds for creating their trading algorithms now. So which is looking at the sentiment, where the sentiment is headed, but generally they takes a good amount of time, that kind of analysis, because it includes a lot of big data and a lot of processing has to be done to make sure that all the text and all such maybe thousands of different sources which are giving the same kind of data, and you are able to create a quantitative sentiment out of that. So it generally takes some time. So they are not, you cannot say that they would be in high frequency parlay, but more on the computational power side, which will be there. Then the unplanned events are just an extra bonus if you are running such strategies, because then you would obviously again be the first one, and if you have more understanding of it, then better you are, if you can make a move faster than the others, then obviously you will be getting an extra bonus for that. All right. So, but then, as they say, there are no free lunches. And why is that? Now, this is something. So, I didn't have the updated numbers here, but this is the data from like 2006, 2010. The global market data infrastructure spending. So, this is just the infrastructure spending which is done to get the market data, nothing else. And these numbers are on the left-hand side is in US dollar millions, and it's about almost, you can see $8 billion almost, which was spent in 2010. And it's not just that it was increasing in US only or Asia Pacific only, but in all across the globe, you see that it is rising. Obviously, it was rising much faster in Asia Pacific, given the lower base. But even in US and Europe, which are already developed markets and have had algorithmic trading or automated trading for decades, even they have been seeing a higher amount of money that is being spent. So this is the kind of money that HFT firms have to spend, and the numbers that you see, say this particular firm did not had a loss-making days in 1,200 trading days. It's just the trading profit that we are talking about. We are not talking. They do not account for the amount of infrastructure and other expenditures they have to do. So obviously you're not taking market risk, so you would not be making losses in the trading as such, most likely, in most of the times. But that doesn't mean that you will be ending your year in in green. You might be ending your year in red despite having made money on each of the trading days in the year, because that's just the trading profit. And it's not just the market data that you have to spend on. You have to spend a lot of money on co-locations, data centers. So like a co-location in, for say, a big global exchange, say in US, would be, one rack would cost you probably around $12,000 to $15,000 a month. So which is a reasonable expense, I believe, and that's just for one rack, which would consist of say 40 to 42 units. Then you have trading lines, so which the trading lines that you take to send out orders to the exchanges. So which also happens to be for most of the exchanges these days, especially for the ones which have ample amount of algorithmic trading on the exchanges, that constitutes for a major chunk of their, a huge chunk of their overall revenues. Inter-destination lines, so this is where obviously the exchange does not make money, but the vendors do. The vendors would be your communication ISPs. So say in India you will have Tata Reliance or Bharti, or in US you have AT&T or other carriers who are there. And the thing is, the interesting thing is that given, like in US you have so many different exchanges, even in India you have more than a couple of exchanges now which are active in certain asset classes, in certain segments. And if you want to connect to them, obviously if you go ahead and lay a fiber line, it won't cost you a lot. Say if it's something which is within a city, maybe it will cost you a few $1,000s a year, which is all right, which is not too bad. But what happens is that technology disrupts, and there is always a new technology which keeps on coming. Earlier we all started the connectivity with ports, then it moved to copper, then it moved to fiber, then it moved to in the last mile with the fiber there still used to be copper, then the last mile became fiber, then the fiber was not enough, so we had so the routes were not optimized, the routes were optimized, and then say Hibernia came, and then other things also came which made sure that the fiber route was as short as possible. Once that was done, then you got that okay, fiber has a limit of it traveling, the data traveling at this much speed only. So you move to more efficient carrier, which is microwave frequencies. So now it's microwave frequency is a fad in which, say, if you want to set up a microwave frequency line between, or rather the link between, say, within US itself, so maybe Chicago to New York, then it would probably cost you maybe for a reasonable bandwidth, few $100,000 a month, right? And even then, while it is going on, it is a more recent thing which is there. There's already a talk of lasers which are being used by some firms, and you can see the articles which keeps on coming by the investigative financial journalists that people are already have started using lasers for communication, which is again even more faster and much more expensive. So that inter-destination line, that's why I said that on the arbitrage side, where you're arbitraging between various multiple exchanges, it's something which comes with a huge cost, because there is no risk, which means that it's just a technology game. Which means that obviously if you are doing classical arbitrage, then it better be worth it, the revenues that you are expecting. Then you have to spend a lot of money on the technology development, so which would be connecting to multiple destinations using you're using a fixed adapters, or since it's easier to maintain, relatively easier to maintain fixed, so there is a harder thing which is connecting to each of the exchanges in their native API, because apparently they are faster for a number of exchanges. It is faster to connect to them in native API, which means more overhead cost as well as more development cost. Then you have hardware, which is you cannot really, if you are in, cannot really continue to have your server for more than, you probably would not like to keep it for more than a year, because within a year there would be a newer version of it with more optimizations done to it. So you will have to probably replace it so that you are not lacking behind in the speed game, and not just hardware, even on the even on the software side, even on the adapters that you're building, the trading platform that you're building. Earlier it was okay, you build in any language till the time it's automated, it's good. Then it was no, you need to build it in C++ or this particular language so that it beats the other adapters which are written in other code bases. Then you had okay, this is you're still programming on an OS operating system, say on Windows or Linux or whichever thing it is, and which is adding to the latency. So you should not have an OS. Okay, all right. So I moved to FPGA. So which is field programmable gateway array. So where you are directly coding the whole strategy, the whole adapter into the microchip itself, right? So by eliminating the whole latency caused by the operating system, and then it is now moving towards that. Okay, why not use switches which can be programmed at the gateway itself, and you can deploy FPGA systems there, and there is no network latency as well. So there is nothing traveling within your network. You just hit the network and you send it back from there itself. So that's the thing which happens for the with the technology which keeps on evolving, and with the evolving technology, it results in more expenses obviously for the firms who are on the speed game side. And then the salaries, because obviously all these things cannot be done by people who do not have a very good understanding or very deep in-depth knowledge of these things. So which is always hard to find, especially given that you need people who understand the financial markets as well as the technology. So it always becomes a challenge, which means less amount of supply and more demand, because you always need such people till the time such firms are there. So which means that the salaries skyrocket, so your salary bills are pretty high too. And if that was not enough, you also have a reasonable gestation period between infra-tech investment that you make and the returns that you can create. So what I mean by that is that there were players, especially in the developed markets, who went ahead, invested a lot in the new technology, and by the time the deployment was done and the whole project was finished, there was already a new technology which was in place, right? So that is the risk from technology. Second is risk from the compliance side also. So what that means is that you have invested a lot for a particular opportunity, but by the time you have prepared your infrastructure for that, that opportunity is no more, say for example, compliant. So there are change in regulations which does not allow you to do that, right? Or there can be some business lobbies which get some rules done against doing that or using that technology. So this gestation period is a high risk period from your operational expenses point of view. Then technology disruption that I have already explained, I think, in details. And then the business environment changes. So that is, you always have the risk of that, okay, the regulations might change. Like in India, STD is increased, but that's not that significant an increase as in to challenge the industry, so it's okay. But then you might have something called that speed bumps, which are being proposed by exchanges like IEX, which have applied for the approval for deploying speed bumps with SEC. Then there are other exchanges or other geographies where they have created HFT taxes. Even in US, that is something which is there in some in manifestos of some of the presidential candidates. So what can happen is that there are business environment changes which can disrupt the whole industry. And what happens is that when that happens, you have to, again, obviously you do not shut down your shop, you just move to another geography, but that means another cost. So that's why the heading no free lunches. So you have to invest a lot to make sure that you are able to make money without taking any risk, without taking any apparent risk. Okay, then this is the like a difference between the skill sets that we're talking about, what you need for having for algorithmic trading to succeed in the HFT as well as algorithmic trading side, vis-a-vis what you have for the conventional trading success. So conventional trading success, it was more of number crunching and patterns, which people used to see. Those who have read that very popular book, Reminiscences of a Stockbroker, who remember that how that person used to actually like, obviously it is a quite an old one, but it's still how he used to look at the numbers and try to make out patterns of that and create or do trading based on that, right? But in the new age world, it's more of the mathematical and statistical understanding. You need to understand what do that data, so basically you have to convert the data that you have, the raw data that you get from the exchanges or from your trade logs, how to create information out of that. Okay, so that you can only do by using statistical tools, because that data is immense. So for an exchange, say in India, in Indian exchanges also, which are smaller in size relative to you have the exchange in US. Say if I compare between NSE and National Stock Exchange in India and Chicago Mercantile Exchange CME in US, so you will have about probably 1 day tick by tick data in flat file for one particular segment. Say F&O segment would be easily between 50 to 100 GB for NSE. The same thing for CME, it would run into, that would be just like 100 GB would be for one of the groups of, so let's say the energy group or one particular or the precious metals group. If you combine the groups together, it would be like hundreds and hundreds of GBs for one particular day. So you cannot do that number crunching and pattern matching manually, so you need statistical tools for that. So that's why you need a mathematical and statistical understanding, a strong understanding on that side to make money out of it. Then execution. So earlier it was typing speed. So in India it was like even before till 2008, and in fact even till 2009. So algorithmic trading was allowed in India in April 2008, but it didn't really take up within the first year, given that there was a global recession which was going on, and people were not really very keen on making a lot of investments on the capital investments to create that infrastructure. Some people did, but not. So so what we used to see was that people who are sitting in hundreds of traders on a desk and just doing in and out using their, like they had this superhuman capability of sending out orders, probably multiple orders within a second. But multiple, I meant 2, and the ones who were like really godlike, they were probably able to send maybe 3 orders. But obviously with the new technology coming in and with the algorithmic trading in place, you're only limited by the exchange, as in how much orders the exchange allows you to send. So every exchange have their own limits. In India, typically the limit is about 400 messages per second, which is you can easily send 400 messages per second. So which means if you know how to code, if you have the infrastructure, then you can send hundreds of messages in a second, as compared to if you don't have the infrastructure and relying on your manual typing speed, then probably maybe 2 or 3. That won't take you anywhere as compared to what other people were doing. Then earlier it was connections, so the flow of information was limited. So obviously those who had, so like in the pit days early on, what you had was the information, those who are inside the pit and they have to pay a huge amount of money to get that card, to get inside the pit, they will know exactly what is going on in the market. But those who are outside, or those who are relying on, say, who are not even in the city where the trading is going on, they would probably get to know only on the next day when the new prices comes into the in the newspaper, and they will know that, okay, this is what the price movement was. But obviously now you're getting the information in almost real time. So if you have, again, the understanding of technology, you can create that, and the market microstructure, which is what kind of order types you can use, what kind of lines you can have. So all those things also makes a lot of difference in your probability to succeed. One thing which has not changed, obviously, is financial markets understanding. You have to have a very good grasp on the financial markets, how the markets are behaving, how the linkages are. So how the commodities market is getting linked with the currency market, which is getting linked with the equities market and with the futures and all those things. So that is something that you need to understand it then, you needed to understand it then, and you need to understand it now. Okay, so that's about the skill sets overview, and that's where the EPAT, as I said, that we would also try to cover on the executive program and algorithmic trading. So that's where it comes into the picture. So that is to provide these skill sets to the people who want to get into algorithmic trading, who want to learn about not just algorithmic trading, but even quantitative trading, or whether it be on the high frequency side or on the low frequency side. So EPAT is a 6-month-long online program. It consists of about 100 hours of live interactive lectures, 200 hours of additional coursework which is provided and offered to you through our learning management system. Then it also includes about 2 months out of these 6 months. The 2 months are about 2 months are for the live industry project, so which is a list of projects that we provide you with. So, and once you pick the project, the relevant domain expert becomes your mentor for the rest of the program. Most of these mentors, as well as the instructors, they're all practitioners. They have very strong industry expertise and professionals as teaching faculty. And we have a pool of more than a dozen faculty members, and it includes the likes of Dr. E.P. Chan, Raji Pura, and Dr. Eve Hilpish. So all these guys who had been, you can see them anywhere and everywhere in the various be it various events or across the globe, or be it various sessions, training sessions. And all these guys are actually into the markets as well themselves. They have been writing books about their exposure, as well as not just theory side, but also they run their own trading firms or the fund management houses, right? And you get 24/7 access to the content through the New Age online portal system, where you can see all the recorded videos. So everything that is covered in the lecture, it's recorded as well. So those who are not in the friendly time zone, or who have to skip a lecture because of some personal emergency, they can get access to that on the learning management system, which also includes not just the recorded videos, but all the quizzes and the assignments and the submissions and the forums, everything which is integrated at one place, which is accessible to all the EPAT students. And then, even though everything is automated, but we still have a dedicated support team, so which ensures that each and every query that we have, any query that you have, that is tracked well, and that is provided, that the earliest resolution is provided to you by the support team, which is working all 6 days to 7 days a week at least, actually. Then EPAT curriculum, which it includes of statistics and econometrics. These are 3 primary modules. The size of the circle ellipse, it actually also indicates how many sessions are there in that. So stats and econometrics. Then you have algorithmic trading module, which is financial computing, which includes of Python, R, and other tools, algorithmic trading platforms. And then we have the module on quantitative trading strategies, which also includes the risk side, derivatives and risk side as well. So, and in addition to that, we also have business environment, say for those who want to set up their own desk, or those who are looking forward to lead the algo trading operations in their organizations, their own or where they are working with. So that part is included in this module as well. Then these are the various modules which we have, which includes, it starts with a primer, which is offered on the LMS itself. As soon as you register, you get access to the primer, followed by the introduction module, and then statistics, which we start with Excel because that's what most of the people are very comfortable with. So the idea is to make sure that people understand the basic statistical concepts by doing, because a lot of focus is there on making sure that people are doing things on their own, as in doing things in a hands-on manner. Then we have another module, the next module, which includes option derivatives and risk, which also includes trading strategies like dispersion trading and other portfolio management strategies. Then we have the advanced statistics with R. So now, once you're familiar with the basic concepts of statistics and with Excel, then we move on to more advanced module on statistics, which is done on R programming. Then there is a whole module on quantitative trading strategies where we cover various trading strategy modules, which includes statistical arbitrage, market making, option-based trading strategies, artificial intelligence-based trading strategies based on machine learning. All those strategies are included in that. Then then the business environment, and business after business environment, you get the algorithmic trading platform, which we run on multiple algorithmic trading platforms, including Quantopian for US equities and also interactive brokers. And we try to cover some other select platforms too, whenever needed. And that is ultimately capped by project work, which you can do from like anything related to algorithmic trading. It's fine. We also provide you with certain topics and complete frameworks on how to go about the project. But if you want to do something on your own, you can do that. So a lot of people, what we have seen, who do the project, they take it as more as a specialization on what their exact requirements are, and they want to specialize. Say someone wants to specialize into, say, machine learning. So there were these some guys from the recent batches who wanted to specialize primarily on machine learning and incorporate that into various trading strategy modules. So they actually went about taking up the project on that, created a framework. They were assigned a mentor, obviously, who can assist them on that, and then they created something which they were like ready to implement it in the real markets as well. The same thing we have done, people doing it on statistical arbitrage as well as other trading strategies, and not just trading strategies, even people who want to develop connectivity to the exchanges, they have taken those things as a project and they have been helped in by the relevant domain experts, because obviously given that all the faculty, most of the faculty are practitioners, so they have developed adapters as well as trading platforms as well as strategies as well as traded strategies for like good number of years now. So, but those who find it difficult to give enough time on the project, there is alternate options for the certification, which is take up the final EPAT exam, so which is again online exam, and once you submit that, if you pass on that, then you are again eligible for the certification as well. So, and then obviously there is we have an active placement cell where this is just a snippet of the various job openings that we currently have. So this I got today itself from our placement team, and it includes people the openings from sales to research to high frequency trading to derivatives analysis to developer programmer to risk management to strategy developer to product development, maintenance, everything which is there. So we have a very strong placement cell which has been growing pretty fast, and which also has strong linkages with most of the leading corporate houses, especially in India, and we are also actively working on the other geographies to expand the reach on other geographies to assist our participants as well as alumni. So this is not just for our participants, this is also open for all our alumni who have the relevant skill set and interest. This is just a snippet of the various countries that we have alumni from. So you can see that we have covered almost all the continents except for Antarctica, which is not visible. So I stand. I'm still right. So we have almost from 30 countries. We have had alumni who have done the EPAT program successfully and are now contributing to the industry in various capacities. And there's just a snippet of the various academic disciplines. So people have come from economics, statistics, computational finance, actuarial sciences, finance and accounting, engineer sciences, which includes computer science programmers, as well as your electronics or other from other engineering science graduates, to business management, which would be various MBAs and other masters in financial engineering, those kind of guys. And they have been working in various capacities, including hedge fund managers, data providers, financial data product developers, traders, brokerage service providers, risk managers, quant professionals, consultants, stock exchanges, all through. So all across the various institutions, as well as entrepreneurs, as well as your individual traders. So that's there. So which is just to highlight how the vastness of the program on how it can be beneficial to a wide range of occupations and academic disciplines. So yeah, so that's about it from my side. So now we are open to the questions. So I see a good number of questions from a lot of you guys. So please do write down your questions on the chat box over here. We will try to take as many questions as possible, given the huge participation that we have had for this particular session. They're like, that's really remarkable.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the QuantInsti's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.